REITs are generally priced at a small premium to the net asset value, and when you think about it, this makes sense because you get the benefits of real estate with the added advantages of liquidity, diversification, professional management, economies of scale, and other things. But then on rare occasions, we see REIT share prices crash, and then they suddenly are priced at large discounts to the net asset value, and that's what we've seen happen over the past year. REIT share prices have crashed by over 30% since the beginning of 2022, and this happened even as REIT cash flows kept on rising, and as a result, the valuations are the lowest in many years, with an average discount to NAV of about 30%. I think that this is a once-in-a-decade type opportunity to buy real estate at a large discount to its fair value, and there are studies to back this up. The investment firm Janus and Henderson went back a few decades and looked at how REIT performed in the following years after they had been priced at a large discount to the net asset value, and what they found is that REIT then significantly outperformed the rest of the market and generate very attractive total returns. I'll put a chart somewhere on the screen of this video. So this explains in short why I've been buying a lot of REITs lately, and today's video I want to highlight 3 specific opportunities that I think are very compelling today. Hey everyone, this is Yossi. I run a small investment firm that specializes in REIT investing, and before I go into the first REIT, I wanted to remind you that we're currently offering a 2-week free trial for my REIT newsletter, High Yield Landlord. If you're interested to access all my top picks, feel free to check it out. I'll put the link somewhere in the description of this video. And then secondly, if you enjoy this type of content, I would really appreciate it if you could like the video. Thank you very much. So the first REIT I want to talk about is called Global Medical REIT, ticker symbol GMRE. This is a small cap REIT that specializes in medical office buildings, and unlike some of its peers, it's unique in that it's going after properties in secondary markets. This unique strategy has historically led to very significant market outperformance because it's been able to tap into a niche of the medical office market that was mostly overlooked by other investors, and so it allowed it to buy these properties with very attractive cap rates and landlord-friendly lease terms. Today its business is doing just fine. Its portfolio is more diversified than ever before. It keeps earning very steady cash flow that keeps on rising according to the lease escalations that they have in their leases by roughly 2% on average annually. But despite that, its share price has crashed over the past year and has been literally cut in half. As a result, it's now priced at one of its lowest valuations ever, with an estimated 30% discount to its net asset value, roughly 8 to 9 times its FFO, and an about 8.5% dividend yield. It seems to us that the market has here overreacted to 2 things. Firstly, the surge in interest rates, and secondly, some fears related to the healthcare sector. We think that the surge in interest rates is a near-term headwind for the company. It has a bit more leverage than average, with an LTV of about 45 to 50%, but this is still very manageable, and I just recently attended the NAREIT REIT conference in New York. I got to meet the management team. They are now clearly focused on deleveraging, and they plan to achieve this by selling a few assets, paying off debt to address some maturities, and so the impact of rising interest rates won't be very significant. Secondly, the issues related to the healthcare sector, the surging labor costs and so on, of course aren't a positive for medical properties, but what the market here appears to overlook is that medical office buildings enjoy very high rent coverage ratios. In the case of Global Medical REIT, it's nearly 5 times, and so there is very large margin of safety in case the profitability of its tenants suffers a bit in the near term. This is very different from other healthcare properties like senior housing, which operates typically with rent coverage ratios of 1.2 to 1.5 times, and so I think that the market here may have overlooked a bit the differences in risk profile between medical office buildings and senior housing communities, or even skilled nursing facilities, which are a lot riskier, and so this could be an opportunity here to buy a stake in this portfolio of medical office buildings at a historically low valuations, and as the management now deleverages the balance sheet a bit and returns to growth, I expect its valuation to eventually recover. I think that the 8% dividend yield is sustainable, and over time I expect to see about 50% upside as it re-rates closer to its fair value. Then the second company that I want to highlight here is called Vonovia, ticker symbol VNA. Vonovia is not officially structured as a REIT, but it operates as if it was one. This is the biggest landlord in Europe. It owns owns mostly apartment communities in Germany, but also some in Austria and Sweden. I've highlighted it previously on this channel, so I'll keep this one relatively short. You can check the link I'll put somewhere on the screen if you want to learn more. So in short, this is a blue chip type company. It has a strong management team with one of the best track record in the real estate space in Europe. It has a strong BBB+ investment grade rated balance sheet. And then third, it owns this very defensive portfolio of affordable apartment communities that generate steady and predictable cash flow that's also steadily growing over time. For these reasons, this company has historically been priced at a small 10% premium to its net asset value during most times, and this really makes sense given what we highlighted earlier. But this all changed when Russia invaded Ukraine, inflation took off, and interest rates surged like rarely before. Investors panicked, they ran for the exit, and Vonovia's share price collapsed to the lowest valuation ever for the company, today trading at a roughly 70% discount to its net asset value. Such large discounts for high quality real estate companies are truly exceptional and would imply that Vonovia is facing an existential crisis if interest rates remain at high levels. I agree that this is a significant headwind for the company, but what I think that the market has overlooked or at least underappreciated here is that first off, most of Vonovia's debt is well laddered, so it has steady maturities each year and it's earning plenty of cash flow that it's retaining to pay off maturities. It's also today able to sell some properties to pay off maturities, and so the near-term impact of the coming years is not nearly as significant as what the market appears to be pricing today. Then the second thing that the market appears to be underappreciating here is the rent growth. Interest rates surged, yes, and this is negative for Vonovia, but the flip side of things is that the interest rate surged because of inflation, and inflation results in rent growth. Because of how rents are regulated in Germany, this inflation is not immediately reflected in its rents, but it's going to boost its rent growth in the coming years. This year they're targeting about 3 to 4% rent growth. Next year is probably going to be more or less the same. And while that may not seem significant, it really adds up over time and compensates somewhat for the rising interest expense. Finally, as I already briefly noted earlier, Vonovia is also now able to sell some of its properties to reduce its debt. The market seems to worry that its net asset value is significantly inflated, but as we've seen in recent property dispositions, this really isn't the case. Vonovia was able to sell recently a property to GMRE, which is a very sophisticated real estate player at just a small discount to its net asset value, and it did so during times that were very difficult because there's little transactions happening in the market. And so I think that this is strong evidence that the net asset value is not inflated, at least not nearly as much as what the market is pricing today. My expectation for Vonovia is that its net asset value is going to come down somewhat as cap rates expand a bit in Germany. Historically, cap rates have been really low, but some of that is also then compensated by the growth in rents. And so I expect it to come down somewhat, but not nearly as much as what the market is pricing today. If we see its NAV come down from, let's say, 55 euros per share down to 40 euros per share, the company will still enjoy over 100% upside potential. And so this is why Vonovia is one of my largest European real estate holdings today. Before I go into the third REIT, could you please do me a favor and like the video? It will really help me to grow this channel. Thank you very much. So the third REIT that I want to highlight here is called Crown Castle. Its ticker symbol is CCI. This is one of the biggest cell tower REITs in the world. It owns over 40,000 towers, and so it greatly benefits from the growth in data consumption, also from the deployment of 5G, and historically it's done really well. It's been able to grow its dividend by 7 to 8% per year on average, and the market has generally rewarded it with a very generous valuation. But this changed recently as its share price was nearly cut in half. It dropped way more than the average even of the REIT sector, and we think that this is a great opportunity. What we think that happened here is that the market overreacted to some short-term news that will hurt the growth of Crown Castle in the coming years. And here I'm referring to T-Mobile's recent acquisition of Sprint, which is going to lead to some lease cancellations because previously in some cases Crown Castle might have leased space on one single tower to both companies, T-Mobile and Sprint, but now since they are becoming one company, they don't need to lease as much space. So it's leading to some lease cancellations, going to hurt their growth, and so this is going to lead to a slowdown in the company's growth in 2024 as well as 2025. But the interesting thing here is that the management has made it very clear that the growth will return to their historic norms of 7 to 8% per year in 2026, and so it's a case of short-term short-term pain for long-term gain. It doesn't really change the long-term thesis for investing in this rapidly growing company, but because of this temporary slowdown in its growth rate, the market has overreacted, probably because most investors really are just focused on the next quarter or next year at most. And so I think this is an opportunity for the long-term oriented investors like myself to pick up shares of a high-quality REIT at a historically low valuation. Today the stock is priced at its highest dividend yield ever of 5.5%. This may not seem particularly high for you, but remember here again that this is a rapidly growing REIT that has been able to grow its dividend by 7 to 8% per year historically. It's also a very defensive one with a recession-resistant business model. It has a strong investment grade rated balance sheet. It has a secular growth trends behind it. And so with that in mind, 5.5% is actually quite high. And then on top of that, it's today priced at a roughly 25% to our estimate of its net asset value. Historically, it's been priced at closer to a 10 to 20% premium to its net asset value. So that's a pretty large gap between its historic valuation and its current one. And I think that this is a buying opportunity. My expectation here is that as the company's growth rate reaccelerates in 2026, the market is then going to reprice Crown Castle also at a higher valuation. And this could lead to about 30% upside from here. Now, that's not nearly as much as what Vonovia could enjoy in upside or even Global Medical REIT. But once more, remember that this is a much safer play, and so the risk reward here is especially compelling for more conservative investors. And so these are three of my favorite opportunities in today's REIT market. If you want to access the rest of my portfolio, feel free to join my REIT newsletter High Yield Landlord for a 2-week free trial. You won't be charged anything for the 2 first weeks, so feel free to just come in and check it out. If you don't like it, just cancel. You won't be charged anything. And then again, if you like this video, could you please click the like button? That will really help me a lot. Thank you very much, and see you at my next one. Bye bye.